If you're over 50, there are 5 kinds of investments you should think very, very carefully about, because once you put your money in, it can be hard, slow, or downright expensive to get it back out. And at our age, a big mistake with our savings doesn't just hurt our account balance. It can change what the next 20 years of our life actually feel like. My name is George Edward. I'm in my mid-70s, and on this channel I try to be the voice I wish I'd had when I was in my 50s. In this video, I'm going to walk you through 5 types of investments that are pushed hard on people our age. They often look safe, smart, or sophisticated, but underneath they can quietly eat your retirement. I'll show you what they are, the red flags to watch for, and more importantly, what you can do instead. Before we dive in, if you're over 50 and you want clear, calm guidance about money in simple English, go ahead and hit that subscribe button and tap the little bell. I started investing seriously around age 50, and I've spent the last couple of decades learning what actually works for people like us. I'd love to walk this road with you so you don't have to figure it out alone. Now, let me share a simple line that has protected me many times. Never invest in a business you cannot understand. That's the heart of what we're talking about today. If you don't truly understand what you're buying, especially after 50, that's your first sign to slow down and maybe step back. The products we're about to talk about are often designed to be confusing, and confusion is where people get hurt. Let me paint a picture you may recognize. It's a Tuesday evening. Robert, 62 years old, is sitting at his kitchen table. Dinner dishes are still in the sink. He's looking at a credit card bill and thinking about retirement. His phone rings. The caller ID shows his bank's name, or maybe the financial company that hosted a free lunch seminar he went to last week. Robert answers, and a very friendly voice comes on. "Hi, Robert. This is Mike from the Retirement Planning Group. We've been reviewing your situation, and I think there's a product that could really help you. It gives you guaranteed income for life and protects you from market losses. You'll never lose money in a crash again." Robert's ears perk up. Guaranteed income protects me from losses. He's lived through 2008. He remembers watching his 401k go down. He thinks, "I don't want to go through that again. This sounds safe. I'm not greedy. I just don't want to lose what I have." A few days later, a glossy brochure shows up in the mail. Big smiling couples walking on a beach. Words like guaranteed, protected, secure, income for life. Charts with nice smooth lines going up. Somewhere in there, in tiny print, are 20, 30, 40 pages of fees, surrender charges, complex formulas, conditions, and rules. But the salesperson doesn't linger there. They flip past that, circle the guaranteed part, and say, "This is what smart retirees are doing right now." There's another line I've heard that rings true. The world is not driven by greed, it's driven by envy. A lot of these products are sold by showing you what other people seem to have. Look at these happy retirees. Look at this guaranteed income. Look at this neighbor who never lost money in the crash. What they don't show you clearly is the real math behind it. They show the dream, not the details. So why are some investments extra dangerous after 50? It comes down to a few basic facts about where we are in life. First, we have less time to recover from mistakes. If you're 30 and you lock your money into something bad, time can sometimes bail you out. You might have 30, 40 years of work ahead. At 60 or 65, that runway is shorter. A bad product with high fees or long lockups can take a slice out of your retirement that you never fully get back. Second, high fees don't just cost a little. They compound against you. If an investment charges 2% or 3% every single year in hidden fees and insurance charges over 10 or 20 years, that can quietly swallow a big chunk of your returns. You can do almost everything else right, save, invest regularly, and still end up with far less than you should simply because too much is being skimmed off the top. Third, illiquidity, that's a fancy word that just means you can't get your money out easily, is dangerous when life is unpredictable. Many of these products have surrender charges, lockup periods, or big penalties for taking your own money back too soon. But what if too soon is when you get sick, or when your spouse needs care, or when a child needs help? When you're in your 60s and 70s, the ability to access your money when life happens is not a luxury. It's a necessity. Fourth, complexity versus clarity. If it takes a 40-page brochure, a 2-hour seminar, and a fast-talking salesperson with a whiteboard to explain it, you have to ask, why? Why does something that's supposed to help ordinary retirees need to be so complex? Complexity is often used to hide fees and risks. If the only way you feel comfortable is to say, "Well, I don't really get it," but he seemed confident, that's a bad sign. There's a simple line I like. In investing, you get what you don't pay for. The meaning is this: The less you pay in ongoing costs and hidden fees, the more of the return you actually keep. Simple, low-cost investments often quietly beat fancy, expensive products in the long run. And after 50, quietly winning is exactly what you want. With that foundation, let's talk about the 5 big do-nots that I see over and over again with people our age. The first one, high-fee variable or indexed annuities sold as safe growth. Now, I'm not saying every annuity on earth is evil or useless, but the way many of them are sold to people over 50 is a problem. Here's the simple version. An annuity is an insurance contract where you give a lump sum of money to an insurance company, and in return they promise certain kinds of payments or guarantees. A variable annuity mixes this with investments in the market. An indexed annuity tries to tie your returns to a market index with complex formulas. Then they add riders, guaranteed income riders, death benefit riders, cost of living riders. Each rider sounds helpful. Each rider also usually adds more fees. Why is this dangerous for many folks over 50? First, the fees. It's very common to see total annual charges of 2%, 3%, sometimes even more when you add up the base contract costs, the investment charges, and the riders. That's money coming out of your account every single year, whether the market is up or down. Second, surrender charges. Most of these contracts have a period, 7, 10, sometimes even more years, where if you want to get your own money back, you pay a penalty. That can start as high as 7% or 10% of the account and slowly decline. If you suddenly need a large chunk of cash for health reasons or family reasons, you might face a nasty surprise. Third, the rules are complicated. The guaranteed income often has strings attached. The market upside with no downside is usually capped or limited. People think they're getting stock market growth with no risk, but what they're really getting is something very different, dressed up in friendly language. Do these ever make sense? In some narrow situations, with truly independent advice, they can play a role. But they should never be the default answer just because you're scared of the market. There's a saying that goes, it's insane to risk what you have and need for what you don't have and don't need. Giving up liquidity and paying big fees in exchange for promises you don't fully understand often fits right into that insane category. The second do not is cash value life insurance sold as an investment plan. You may have heard names like whole life, universal life, indexed universal life, or IUL. These policies combine life insurance with an investment or savings component. They're often pitched as tax-free retirement income, guaranteed growth, or a smarter alternative to your 401k. Here's the problem. These policies pay very high commissions to the person selling them. That doesn't automatically make them bad, but it does mean there is a strong incentive to push them, especially to people with decent savings and fear about taxes or the market. The contracts are long, complex, and full of assumptions. If you try to get your money out in the early years, you often face significant penalties because so much went to fees and commissions up front. For someone over 50, starting a brand new cash value policy can be very expensive. The cost of the insurance part is higher because of age. The time for the cash value to grow enough to be useful is shorter. Often, you would have been better off buying simple, cheap-term life insurance if you still need protection, and putting your savings into straightforward investments you control. There's a line that always hits home for me. The investor's chief problem, and even his worst enemy, is likely to be himself. When we mix fear of death, fear of taxes, and a polished sales pitch promising a tax-free retirement, we can become our own worst enemy. We want to believe there's a magic product that solves everything, but usually the magic is mostly on the salesperson's commission statement. The third danger zone is non-traded REITs and illiquid real estate schemes. A REIT is a real estate investment trust, a company that owns a bunch of properties and passes the income to investors. Publicly traded REITs are bought and sold on the stock market like any other stock or fund. Non-traded REITs are not. They're often sold through seminars or exclusive offer meetings. The pitch sounds good. You get income from real estate. It's not tied to the stock market. This is a special, stable investment that wealthy people use. But there are big dangers. These things can be very hard or impossible to sell quickly. The value of your shares can be set by the company itself with little transparency. The fees and commissions are often high, meaning less of your money actually goes into buildings and more goes into pockets along the way. For someone over 50, tying up a big chunk of retirement savings in something you can't exit easily can be painful in emergencies. If you need money, you can't just click sell like you can with a simple fund. You may be told you have to wait or take a big discount to get out. I like a line that goes, go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. With real estate investments, if you need a thick legal document and a complex structure just to understand how it works, that's a red flag. Good real estate investing doesn't have to be wrapped in mystery to be worthwhile. Now let's talk about the last two do-nots. Number 4, high commission alternative products and structured notes you don't understand. These show up with all kinds of fancy names. Structured notes that promise double the upside, limited downside. Private funds that require large minimums and promise exclusive access. Exotic hedge strategies that claim to make money in any environment. The sales angle is often, this is what smart, rich investors do. This is sophisticated. You're not like the average person who buys simple funds. That plays to our pride. After all the years we've worked, we like to feel we've earned something better than the basics. But what are you really buying? Often you're buying layers of fees, complexity, and legal language. You may not truly know how the product makes money, how it can lose money, or under what circumstances you could end up with less than you started. Many of these products are built more to generate fees for the issuer than to serve the person buying them. There's a sharp little saying that fits here. If you don't see the sucker at the table, it's you. In many complex Wall Street products, the sucker is the person who doesn't fully understand what they're buying, but goes ahead anyway because it sounds impressive. You don't have to be that person. Number 5, get-rich-quick trading and speculation. Penny stocks, options gambling, hot tips, next Bitcoin stories. This one isn't about a specific product. It's about behavior. It's day trading from your phone, trying to double your money fast with options. Chasing meme stocks or tiny coins because a neighbor or someone online said, this one can't lose. Why is this extra dangerous after 50? Because every big loss really counts now. You don't have endless years of high earnings ahead to refill the bucket. And the emotional stress is real. I've seen people in their 60s literally lose sleep watching screens, riding wild swings, thinking they're investing, when really they're just gambling with their future. A man I knew took about $20,000, his hard-earned savings, and started playing options because a friend had made a quick profit. Within a few months, that $20,000 was under $5,000. The friend who had bragged about his big win, he'd taken his profits and walked away. The man who followed the tip was left starting over at 61 years old. There's a line that always calms me down. Don't do something, just stand there. Real investors don't need constant action. If an investment feels like a casino, lights, excitement, fast moves, it probably is one, at least for you. When in doubt, step away. So if these are the 5 things to be very cautious about, what should you focus on instead, especially after 50? First principle, if you can't understand it in plain English, skip it. A simple test. Can you explain the investment to your spouse or a friend in 2 or 3 clear sentences? Can you say how it makes money, how it can lose money, and how you can get your money out? If not, be careful. Trust me, it's complicated is not good enough when it comes to your retirement. Second principle, favor liquidity and simplicity. For many people over 50, that means putting most of their long-term money into broad, diversified index funds, simple bond funds, CDs, or government bonds. With these, you can see the price every day, you know what you own, and if life changes, you can get to your money without reading a 60-page contract. Third principle, keep your costs low. A fee of 1% or 2% every year may not sound like much, but over time it's a big leak in your boat. That's money coming out of your pocket, not just this year, but every year. Low-cost index funds and straightforward accounts usually beat expensive, complex products, not by being clever, but simply by not taking as much from you. Fourth principle, use insurance as insurance, not as an investment. If you still have people depending on your income, term life insurance can be a good, cheap way to protect them. But your investments for growth and income, your IRAs, 401ks, brokerage accounts, should be separate. When one product tries to be both your insurance and your investment, it often does a mediocre job at both and a great job at generating fees. Fifth principle, get a second opinion before you sign anything complex, and not from the person who's about to earn a commission if you say yes. Look for a fee-only advisor who works as a fiduciary, meaning they're obligated to put your interests first, or at least run it by a trusted, knowledgeable friend who has nothing to gain from your decision. It is perfectly fine to say to a salesperson, "Thank you, I'm going to review this with my advisor, and I'll get back to you." Any honest professional should respect that. There's a line I've come to believe deeply. The greatest enemy of a good plan is the dream of a perfect plan. You don't need a perfect, fancy, complex product with every bell and whistle. A simple, low-cost, understandable plan is more than enough. Don't let the dream of something perfect push you into something you don't understand. Now, let's make this practical. What can you do this week to protect your money? First, make a list of everything you own. Grab a notebook or open a document and write it out. Account name, IRA, 401k, annuity, life insurance policy, brokerage account, REIT, whatever it is. Then write the company or product name. Then write its basic purpose in your life. Income later, life insurance, growth, emergency fund, and so on. This alone is eye-opening for many people. Second, circle the ones you don't fully understand. If you can't describe in one or two plain sentences how that thing is supposed to make you money, how it could lose money, and how you get your money out, put a big question mark next to it. Those are the ones you need to shine more light on. Third, check for red flags. Ask, are there surrender charges if I want out early? Are the fees over 1% per year when I add everything up? Is it hard to sell or cash out? Did someone make a big commission when they sold it to me? You won't always know all these answers right away, but the more yes answers you have, the more cautious you should be about adding more money to that product. Fourth, before you put any new money into anything that looks or sounds like what we've talked about, get that neutral opinion. Take your list to a fee-only advisor if you can, or to someone you know who has a track record of being wise with money and who is not trying to sell you anything. Ask them to explain it back to you. If they can't, or if they say, this is awfully expensive and complicated, listen. Fifth, focus new money on simple, transparent investments. For most people over 50, that usually means diversified stock and bond index funds in your retirement accounts, plus safe places like CD ladders, high-yield savings, or treasury bills and bonds for short-term needs. Nothing exotic. Nothing that requires a thick binder to understand. And let me say this very clearly. If you already own one of these 5 types of products, do not panic and blow it up tomorrow morning. That can sometimes make a bad situation worse. Instead, educate yourself first. Find out exactly what you own, what your options are, what the costs are to change course. Sometimes the best move is to keep what you have but stop adding new money. Other times there may be a reasonable way to transition out over time. Move carefully, not emotionally. The biggest win for many people over 50 is not discovering some new secret product. The biggest win is simply avoiding the traps that drain their savings. Not losing big is often more important than hitting a home run. There's a simple pair of rules I try to live by. The first rule of investment is don't lose. The second rule of investment is don't forget the first rule. When you're over 50, following those rules means being especially wary of anything that locks up your money, charges high ongoing fees, or relies on you believing promises you don't fully understand. If this video has helped you see a few things more clearly, do me, and more importantly, do your future self a favor. Click the like button so YouTube shows this to more folks our age who need to hear it. In the comments, tell me this. Have you ever been pitched one of these 5 kinds of investments? Which one and how did it go? Your story might help someone else avoid a mistake. If you haven't yet, hit subscribe to join me here on George Edward Explains and tap the notification bell. In upcoming videos, we'll talk about how to build a simple, strong retirement portfolio, how to turn your savings into income you can live on, and how to avoid the biggest money traps aimed at people over 50. And if you know a friend, a sibling, or a coworker who just went to one of those free steak dinner investment seminars, share this video with them. It might be the nudge that protects decades of their hard-earned savings. You've worked too hard for too many years to let confusing, high-fee products quietly rob your future. Keep things simple, keep them clear, keep them low cost, and above all, protect yourself. I'm George Edward. Thanks for spending this time with me, and I'll see you in the next one.